Welcome to ODEON Capital Conversations on all things money and markets with Dick Bove and Matt Van Alstyne. And here is your host, John Aidan Byrne.
Homeownership in America is facing fresh headwinds as mortgage rates recently hit their highest levels in over 20 years, and with the existing costs of purchasing a home reaching historic highs. One study says home prices will continue to rise into next year as existing home sales decline. Dick Bove is out with a new report on housing and says once again the nation is now facing a potential housing collapse. The solution, he says, could be the financial liberation of the joint housing agencies Fannie Mae and Freddie Mac by Washington. We'll parse the recent comments of Fed Chairman Jerome Powell in Jackson Hole, Wyoming. Dick says the Fed chair was clear, inflation is still not beaten. Matt Van Alstynne says Powell did not appear to tip his hat on the future course of interest rates. Banks continue to face competition for consumer deposits. We look at bank consolidations and at the steady decline in the number of brick and mortar bank branches in America. We look at China's troubled economy and at Germany, forecast to be the only major economy to contract in 2023. I'm with Dick Bove, Chief Financial Strategist at ODEON Capital Group, and Matt Van Alstynne, ODEON co-founder and managing partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, welcome for episode 84. Inflation, interest rates. Do we have a better sense of the trajectory of US interest rates than we had a week ago, now that Fed Chair Jerome Powell gave his speech in Jackson Hole, Wyoming? He said the Fed remains committed to bringing inflation down to 2%, which was interpreted by many as meaning more rate hikes could be coming. Surprisingly, markets were positive on the news. You would have thought they would have moved in the other direction. Inflation is down from 9.1% last June to around 3% today as measured by the CPI. A quote from Jerome Powell at the Fed's conference in Jackson Hole. Although inflation has moved down from its peak, he said, it's a welcome development. It remains too high. We are prepared to raise interest rates further if appropriate. Maybe if appropriate are the operative words. Your thoughts?
Well, I think that he was extraordinarily clear in what he was saying last, I think it was Thursday or Friday, I guess, in that he said, look, inflation has come down, but it has not been beaten. We don't think that it's appropriate to, take measures as if it had been beaten. We are going to continue to be, following the same policies as that we followed before. And that does not rule out our, increasing interest rates going forward. So he's clear. I mean, he's not equivocating in any shape or form, and neither is the IMF equivocating or the European banks. So it's clear that's what they believe. All right. The market believes the following. Number one, it believes that it doesn't matter what they say anymore, that we've had interest rates at this, relatively high level for now some time, and it has not caused the economy to go into a recession. And therefore, he can talk all he wants about whatever he wants. It doesn't matter because the market, the economy has absorbed it, and therefore we're going to look forward. Number one. Number two, there is this belief that, he doesn't mean what he says. I mean, we've dealt with that belief for over a year now of people in the market believing that he's saying this stuff, but he doesn't believe it, and he's going to blink, he's going to whiff, he's going to do what have you. So that view is also driving the market. Third view is that it's taken hold, or at least the view has taken hold, that the economy is not going to have a recession. It's going to be what people like to call a soft landing. And as a result of that, the market is saying, again, I don't care what he says. The economy is doing fine. We can handle high interest rates. He is going to blink at some point, and the market is ignoring him. I don't think the market should do that. I think the market should not ignore him, because I believe that these wage agreements that are being made of late are just mind-blowing. We're talking about 30 and 45%. UPS, I think, made a 55% wage agreement over a 5-year period, right? They're going to increase wages 55%. The airline pilots that we've discussed before getting 45% over a 4-year period. So, inflation is not dead. And it is definitely something that the Fed is not going to walk away from. So I think that you should expect to see more interest rate increases before this situation is over with.
You referenced the ECB president who was at Jackson Hole as well, and inflation in the Eurozone is at 5.3%, at least in July. And so she was committed to bringing, or the ECB is committed to bringing it down to a 2% target rate.
I think what Dick is actually saying is right, but I also feel like what Jay Powell was saying is it's data dependent. He wasn't really predicting active rate increases, nor was he predicting rate cuts. He kind of, as far as I could tell or believed, kind of said a lot of nothing. And it was, to me, different than, in 2021, where he was confident that inflation was transitory and that they wouldn't have to do any interest rate hikes in the foreseeable future. I believe he made, intimations that they wouldn't raise interest rates for a number of years. And, only 12 months or 6 months later, he was going against that. So I feel like he learned the lesson that he was crucified for being wrong on transitory inflation. So I feel like his speech this time was not a tipping of the hat one way or the other. And I agree with Dick, these wage increases are, eye-opening, but in a lot of ways, wages have been for decades trending below inflation wage increases. And so I think it's entirely possible you have a catch-up period that doesn't really accelerate inflation. So I feel like it was a very cautious speech, and it wasn't determinative one way or the other. It
was evidenced by the fact that he said that we're guided by the stars on a cloudy night.
Yeah.
He said that, and that I was shocked when he said it, and that's what most people seem to have picked up. It's a cloudy night, and therefore we're not sure where we're going at this point. But
so
again,
he's kind of a poet as well, I guess, in his part-time or in the evening. You're talking about wage increases, Dick, because you mentioned that a couple of weeks ago on an episode about all the unions and your own family situation. I think you have a family member who is a pilot, and so you're very close to what's going on there. Among postings for more than 20,000 job titles on SIP Recruiter's site this year, the average pay for a majority of roles has declined from last year. So while there are wage pressures, also it's working in the opposite direction. Companies are cutting pay for a lot of new hires, at least in the low income categories. I think there's evidence of that.
Well, a lot of companies, as you mentioned, John, and we've seen these technology companies are repeatedly laying off people and downsizing and readjusting to the fact that money is no longer freely available for them to explore, expansion in multiple areas. So, in that sense, it's correct. But, the base worker in the United States has gotten a huge wage increase. I mean, the minimum wage is not $9 anymore. The minimum wage is somewhere between $15 or $18 per hour. The wage data, which is put out every month by the Labor Department, shows wage increases every month. They're not showing wage declines. So, yeah, of course, there are certain segments of the population which are not benefiting by it, but there's no major, if you will, entity like the United States Department of Labor that is recording wage declines. Wages are going up, and they're going up faster than the rate of inflation. They're going up at 4%, and as you indicated, the inflation rate is 3%, and that means that wages are going to pull inflation higher. Now, that may be true that it's a catch-up situation, but, wages are going up faster than inflation, and that will pull inflation higher.
I mean, when you say that will pull inflation higher, I mean, first off, inflation is just a measurement of prices. So you're implying that higher wages will increase prices, which I believe is possible. But right now, like you look at like the airline industry, and the pilots are getting these even more eye-opening pay raises than UPS. And you go and look into the detail of the ALPA, the pilot unions, puts out, you can go to their website and they put out like data on what they believe are fair prices. And they kind of imply that they haven't had inflation adjusted wages, are set back in the 2000s. Like they have not had, I say 2000s, I mean, actually the year 2000 was the last time they got sizable pay increase, because 2001, obviously with the events of 9/11 and the downturn in air travel, and it took almost a decade to recover. And just as they were recovering, you had the financial crisis, and just as they were recovering from that, you had the COVID. And pilots have been basically receiving pay decreases relative to inflation, according to the ALPA, going back 20 years. And that this is just a catch up. And their prediction is that airlines aren't going to have to raise prices too much to afford it. And so, I get the point, because it becomes this feedback loop where higher wages require companies to charge more for the services. Therefore, inflation goes up. And because, services cost more than other employees are demanding wage increases, it becomes this cycle that can only be broken by a rapid increase, or at least a sizable increase, of unemployment. And that's what breaks the wage increase cycle. And then that reduces demand, and that breaks the inflation cycle. But, and I'm just trying to be skeptical here, not saying I necessarily agree, the argument that this is not one of those feedback loops is that this is not, this inflation that we've experienced over the last, call it 18 to 24 months, has not been because of excessive demand. It's been because of impacted supply, and the lack of supply has caused prices to rise rather than increased demand. And so the theory is that we're coming out of COVID, supply is going to increase rapidly, which will mute the demand, the ability for demand to increase the prices. So when you get these pay increases that are catch-ups to traditional inflation, that in theory the pay will actually not be spent on increasing demand in the consumer sector. It'll be spent on investments and savings, and thus we'll have a soft landing without spiraling inflation. At least that's the argument I'm hearing. And so I hear what you're saying, Dick, but I just wonder if it's more emotional than data-driven when you have decades of these particular industries not getting paid relative to inflation.
Yeah, but you're the one who taught me that incomes are rising faster than costs, right? In other words, a few weeks ago, you, based upon what you said, I went back and took a look at the numbers, and because I thought you were not correct, and it turns out you were correct. You said was that incomes are rising faster than prices, and that, that has been true, as you indicated, for long periods, and you were exactly right. Incomes are rising faster than prices. So they may be thinking they're catching up in some places, but if incomes are rising faster than prices and have done so consistently, then I'm not sure that catch up is the whole ballgame here. I think that, I think that wages are going to drive higher price. Plus, company margins, company unit sales may not be doing better, but company margins are not falling. So the net effect is there's no resistance to price increases yet, in the marketplace that you would expect to see. So I don't know. I'm concerned because maybe because I follow banks so closely and inflation is killing them with these increases in interest rates. The banks are right now sitting ducks in a gallery where, any money market fund or a brokerage entity can take pot shots at them and they'll hit every time. So I'm on Powell's side, I guess, in this debate.
These rising interest rates, Dick, have bitten, right? I mean, and I'm sure there are a lot of consumers, ordinary American consumers, worried about more rates. We saw mortgage interest rates hit over 7% in recent weeks. That's the highest since '01. And it's having some kind of a ripple effect on the housing market. Applications fell to their lowest level since 1995, even as prices in some markets rise and even as home sales in some markets are up. But overall, as you made clear last week, home sales of new existing homes are down across the board. Just one little side note on that. This just to me was kind of mind-blowing in a way. Zillow just came out with a report saying that US home prices are set to rise more than 6% by next summer. But other firms, of course, are predicting a slight decline. And Zillow is now offering home buyers a 1% down payment on a newly purchased home to help alleviate the pain. There could be an element of marketing chutzpah with Zillow, but nobody else has said prices are going to rise by next year that I'm aware of. I'm sure there are other agencies, but these rising interest rates.
They are rising. Housing prices are rising. They're not falling. The last 3 months, housing prices have gone up. So the fact of the matter is that they're not talking about something which is, just this wild ass guess is what's going on. Housing prices are rising again. They're doing it at a time when mortgage rates are rising, and it is more expensive to buy a house in the United States today than at any time in the history of this nation, because housing prices are up and mortgage rates are up. Mortgage rates are only slightly below peak that they hit, in the early part of the century. Of course, they're way below where they were in the 1970s and 80s. But, if you take a look at what the affordability is of housing today, it is the worst that it's been in 30 years. Now, that therefore makes it very confusing as to how housing prices keep rising in that environment, but they are. And this 1% game is what caused the crash in the market in 2007 and 8, because that's the game. You suck the borrower in by saying, we're going to give you a 1% rate. It's called a modified mortgage. We'll give you 1% for 3 years, and then after the 3 years, you jump to a full market rate. And by the way, all of the interest that you didn't pay in the first 3 years is tagged on to the balance of your mortgage. So 3 years in, you find yourself sitting with a mortgage balance which is bigger than when you started, and with an interest rate which is dramatically higher than when you started, and then you have a collapse. And that's what happened in 2006 and 7.
So housing prices nationwide are rising. The prices are rising, but sales of existing homes have declined somewhat.
Let me correct. You're right. Existing home sales are down dramatically. And we have the numbers showing that, but because we don't have a contract with the National Association of Realtors, I cannot publish them or comment on them, but or mention what they are. So I have to deal with the prices of new homes, because that we can comment on, and they're not doing badly. They're not doing badly at all.
Well, new home sales is where the action is, because people that own houses aren't selling for logical reason, because they can't replace their existing stock or mortgage payment without a dramatic decline in quality or a dramatic increase in mortgage payment. So I think this is much more a supply issue than, or a lack of supply, because, if you want to quote unquote upgrade your house or upgrade your neighborhood or move slightly closer to work, well, if you bought your house, and let's say it's an average house of $550,000 and you bought it in 2019, your payment is about $800 a month. A house that has a payment of $800 a month is going to be like a $150,000 house right now, which doesn't exist. Or to move into a $500,000 house on the equivalent level, but you have to switch from your 2% mortgage to a 7.5% mortgage, your mortgage payment goes up to $2,500 a month. And so no one is moving from their existing house. And that is why all the action is in the new home sales. The only people that are moving are people who are getting divorced or have a dramatic lifestyle change, like, job moving overseas or something like that. Everyone else is staying put. And that is the biggest reason we have a housing crisis.
I think that's clearly one of the big reasons. But I think there's a and you're correct. If you take a look at the percentage of vacant homes in the United States today, as a percentage of total homes in the United States today, it's at the lowest level in this century, except for the year 2000. In other words, the amount of vacant homes available for sale in the country, or even vacant rentals, is again at the lowest level. What I think we're looking at is a potential housing collapse. All right. Because I don't think that what is happening now is sustainable. In other words, as you correctly state, Matt, there aren't a lot of houses coming onto the market. The houses that come onto the market cost too much for a large portion of the population to afford. But the reason for it all is there's a lack of money supply coming into the sector. In other words, the funding of the housing industry, which traditionally came from banks in the beginning of this century, came from asset-backed mortgage securities, is not there. The mortgage pools that were once backed by the U.S. government through Ginnie and Fannie and Freddie, they're not there. So the net effect is we don't have funding for the housing market. We're having prices, again, at the highest level ever in the history of the country on a monthly payment basis. We don't have a lot of houses coming onto the market. It all says to me that we're going to see a collapse in the housing market, because what we do have is this tremendous increase in demographic demand. When we had the housing boom in 2000 to 2006, there was no increase in demographic demand. It was, in other words, what I'm trying to define here is it's not the demand for the product that counts, it's the availability of money to fund the product which counts. Because from 2005 to 2006, what we saw was a decline in the number of people aged 25 to 44. We saw no growth in the age of people under the age of 15. You have a baby, you got to get a bigger house. You can't live in an apartment. And yet we had a housing boom. And it was because all of these sources of money for mortgages had poured into the market. Now we have demand from an increase in the population, demand from an increase in the number of babies being born, and a decrease in the number of houses being sold, because there is no flow of money coming into the marketplace. And there is a constriction on the flow of money coming into the marketplace, because the banks don't want to do it. The mortgage brokers are losing money because of the rapid rise in interest rates, killing the gain on sale profit. So, I think it's a crisis. That's the reason why I think, again, I do own shares in Fannie Mae and Freddie Mac, but I do think it's the reason that Fannie Mae and Freddie Mac have got to be let free from their conservatorships, because historically, in times like this, it's money flowing through those two companies, which have slowed down interest rates in the mortgage market, and which has provided funding for the purchases of housing at lower prices. So, but I don't know that that's ever going to happen. But basically, I've bet my own personal money that it will happen. Okay.
I'm trying to understand that, Dick. So you're saying if Fannie Mae, Freddie Mac, those agencies were freed up and allowed to function properly under free market conditions, it would influence the direction on interest rates. It would make the affordability of home ownership more positive. It would reduce interest rates for home buyers. Is that what's going on?
Yeah, that's exactly what I'm saying. In other words, basically, we've got almost 100 years of history to show that statement is not a fanciful statement. That's what Fannie and Freddie have done since 1938 when they were created. Fannie was created in 38. Freddie was created in 1970. But that's what they've done since their life as entities. And the way that they can do it is they're the only companies in the world that can offer a 30-year fixed-rate mortgage with the principal interest guaranteed by the U.S. government. Now, whether the U.S. government wants to explicitly state that they're guaranteeing that principal interest or not is immaterial, because the market accepts the fact that they do. 2007, 8, they proved that they do. 2019 to 20, Two, they prove that they do. So the net effect is they are unique entities. They have the capability of turning this housing crisis around by low, because their cost of funding is low, all right, because they're government guaranteed, debt. Again, the government won't say that, but we know that that's true. So, they have a lower cost of funding. They have the ability, as a result of that, to flow money into mortgages. They have access to, government guarantees on the products that they're selling in the market, which is debt against government guaranteed, houses, mortgages, and interest payments. And therefore, they've got to be set free if we're going to avoid this housing crisis. And they're not free at the moment, and that's a problem. And one other thought: in 2019 to 2022, when we were in this crisis, the Federal Reserve stepped up, and 30% of the funding that Fannie and Freddie got was from the Federal Reserve. All right. The Federal Reserve can't do that anymore because it's inflationary, right? So the net effect is the private sector has the money to put into Fannie and Freddie debt if the government would just get them out of this socialistic situation where the government owns them and runs them and put them back into the private sector. And I think ultimately it's going to happen, which is why I own stocks in Fannie and Freddie. Okay, I have to say that, full disclosure.
Do you think that it's going to require this housing crisis that you're predicting to liberate Fannie and Freddie, to get them serious? I mean, we talk about this a lot, but I feel like we've been hearing about Fannie and Freddie's supposed liberation for 12 years, and it seems like an intractable problem that no Secretary of Treasury can get their arms around, and no president can, get over the finish line. It requires Congress, it requires a president, it requires kind of a global consensus of what is right and wrong between government and government backing and private funding. And there's this whole meme of heads I win, tails you lose, type of thing when it comes to the GSEs, and it's intractable. And I just wonder what type of crisis would, because it seems like Washington does respond to crises, but other than that doesn't function very well. What type of crisis would liberate Fannie and Freddie? Or do you think it's just more of like a great leader is going to emerge in this presidential election and just have this good idea and get it over the finish line? I just wonder how this happens.
I mean, we know Donald Trump, and I'm not recommending you vote for him or not vote for him. Donald Trump has written a letter to the Supreme Court indicating that it was his intention to take these companies out of their conservatorships. And the Supreme Court ignored the letter, but it's there and it exists, and we've actually published it.
But that's my point. If a president has an intention to do it and can't do it, what does it take? But he didn't.
Can't do it. The reason he's claiming that the reason why he couldn't do it is because the constitutional. Let me say this more simply. The head of the Federal Housing Finance Agency was a guy named Melwatt, who was put there by President Obama, right? Under what was believed to be the terms of the time, the President of the United States could not remove the head of the FHFA. The head of the FHFA has the freedom to do whatever he chooses with Fannie and Freddie. And that has been certified over and over by one court case after another, all the way up to the Supreme Court. So in Trump's letter, he says clearly, I would have released these companies, but I couldn't fire Melwatt. And because I couldn't fire Melwatt and he didn't want to release these companies, I couldn't do it. But it's my intention to do it. All right. So, and the Supreme Court ignored the letter, and continued on the view that it's up to the head of the FHFA to release these companies or not. However, the Supreme Court overturned the limitations that Trump had, so that if Trump were to be elected president again, I'm not saying vote for him, I'm not saying vote against him, I'm just saying if he were to be elected again, he will do it.
Interesting.
He said he will do it, and he will do it. The Democrats have a different approach. The Democrats see this huge amount of money pouring in from these two companies. These two companies are paying the government tens of billions of dollars a year. 96% of all the revenues that Fannie Mae generates in a year goes to the Treasury. 81% of all the revenue. Now, we're not talking profits. We're not talking after tax. We're talking top line revenues. Top line revenues. 81% of Freddie Mac's top line revenues go to the U.S. government. 96% of Fannie Mae's top line revenues go to the U.S. government. And that's why these Treasury secretaries, I'm going to use a crude statement, wet their pants is when they think of basically, taking him out of the Treasury because it's too much money to give up. These companies have given the government over $200 billion in the last 12 years, and the government doesn't want to give it up. Trump says, we're going to do it. We're going to give it up. They should be private companies. Biden is not saying anything, yet. But if everybody's wrong and we don't have a soft landing, and we have a recession next year, and the recession is driven in part by a collapse in the housing market, you better believe that Fannie and Freddie are going to be released. They don't have to go to Congress. All they have to say is, you are released, and they're gone from the government, if the government controlled. Now, obviously, they're not going to say anything as simplistic as that, but they do not have to go to Congress. Mark Calabria, who was the head of the FHFA, in fact, he's written a book. Again, I didn't read the whole book. I just read pieces of it. Mark Calabria, who was the head of the FHFA, clearly indicated that the power exists for the president to act without Congress. And he gave a number of interviews when he was the head of the FHFA, indicating that he had the power to release these companies. Treasury Secretary said, don't you dare do it because there's too much money that we lose if you do it. You get a recession driven by a collapse in housing, which I think is highly probable, they'll be released.
I'm glad you brought up Mark Calabria because you said something about SCOTUS and that prompted me to look it up, and I found the ruling, and it was a ruling that SCOTUS issued in early 2021 that confirmed that the president has the ability to fire anyone in the executive branch, and Joe Biden reacted by firing Mark Calabria, who was the head of the FHFA at the time. And I found, I went back and I just found these articles talking about how Calabria was heavily pushing for what you're advocating, and that he couldn't get Mnuchin to give him permission to do it. And I can't figure out why Mnuchin didn't give it, but it seemed like Trump was for it, Calabria was for it, and they couldn't get it done for some reason. Is there some intractable problem inside the government that
All right, well, let's make sure you understand. Number one, that it took the Supreme Court to make its decision in the Collins case to allow, Trump to have to allow Biden to have the ability to fire Calabria.
Correct.
Right? Before that, it could not be done according to everybody's view of the law, including Trump's. All right. All right. So now Trump has the ability to fire, to put Calabria in position. Calabria wants to release him, and they're not released. Why not? Well, that I lost a hell of a lot of money. Why not? Because no one thought that Mnuchin, would basically refuse to do what he said he was going to do. Now, why did he refuse it? Well, you had the whole COVID situation explode upward, which they're giving as a reason. But the real reason, in my view, is the Treasury didn't want to give up the money. The head of the Treasurer of the United States, the Secretary of the Treasury of the United States, who is responsible for the funding of the debt of the United States, did not want to give up that revenue. And he refused to do it. And Trump was so, tied up with all this other stuff that this thing was not an issue. The housing market was not giving people fits. Calabria, had bowed to Mnuchin's wishes, and they weren't released. You get Trump as president, you get Calabria back as the head of the FHFA, these companies will be released. But, again, who knows?
So, Dick, just to kind of sum up some of this, Trump, or Biden, not Biden, I presume, but it could become a campaign issue next year if we enter this housing crisis that you say is a very real possibility. If Fannie Mae, Freddie Mac are liberated, taken out of conservatorship, that's a very deep in the weeds type of dynamic. So mortgage rates today are over 7% in a liberated environment. Would mortgage rates drop eventually because of the liquidity coming out of Fannie Mae, Freddie Mac?
It's a fund flow situation. In other words, take it from the bank's position today, right? the banks are getting picked apart by the fact that they have assets, say home mortgages. All right, so the situation is very simple. The banks are sitting here with these huge mortgage portfolios, which are yielding on average 3.4% to 3.6%. The market rate for deposit money right now is over 5%. So the banks are not willing to allow mortgage rates to come down. They want mortgage rates to go higher so that they have enough money to cover, the amount that they have to pay for bank deposits. All right, in the mortgage banker situation, they keep raising the rates, the interest rates in the short market, which is driving the long market in mortgage rates up. That means that their warehouse of products are constantly declining in value before they can sell them. So that they're not in a position, unless they have huge servicing portfolios, they're not in a position to allow mortgage rates to come down. All right, so where else are you going to find money for mortgages? Well, the private equity firms, they're not about to cut rates on mortgages. So who's the only entity that can come into the market that is willing to cut rates on mortgages because the government is covering its losses in any way? It's Fannie and Freddie. But they can't do it because the government's got them locked up in a conservatorship. Take them out, put them into the open market, mortgage rates will come down, mortgage funds will flow more freely, people will be able to afford houses much better, and they will recognize that, I think, in 2024, when we've got this, I think, legitimate crisis in housing.
You have a new report out on housing, digging deeper into housing. Money costs and flows are the biggest issue. And you mentioned demographics in that, Dick. We'll move on to banking in a moment. One interesting data set was most first-time home buyers are aged 25 to 44. Okay. Surprisingly, in the housing boom in 2000 to 2006, they were actually declining in numbers, according to your report. And that housing boom was not the result of demographic pressures. You go on to say in 2010, at the beginning of the housing bust, the numbers started to change. The number of people in ages 25 to 45 began to grow. That growth is expected to continue until 2034, when it will begin to taper off. That's good demographic numbers, but we have to have enough houses to fill to give them an affordable home and a place to live.
Yeah, you need some money. It's money. In other words, the whole point of what you just said is that there was plenty of money around from 2000 to 2006, and they built a heck of a lot of houses, even though there was no demographic demand. There's a big demographic demand after 2010, but they weren't building houses because they didn't have the money. And, why didn't they have the money? Well, in housing, we know, going back to 1938, that the money gets released when Fannie and Freddie, 1970 for Freddie, when Fannie and Freddie are allowed to function in the open market. And the government won't let them do it because the government doesn't want to give up the tens of billions of dollars that Fannie and Freddie pay them every year. And therefore, it's going to take a major crisis in housing, which I guarantee you we are going to get, that will allow that to change.
Dick, banks continue to be under pressure, capital requirements. You spoke quite frequently on recent episodes about consolidation in the industry, the regulations coming out. I just saw a news report this morning about these living wills. What the heck is all that about? You may want to explain that. But there's an interesting study out this week, by the way, from Upgraded Points. Just a little interesting side note. Banks continue to close branches and ATMs, and the number of brick and mortar bank branches, including credit unions, peaked in 2011 at just over 105,000 nationwide. Now it's down to 94,000. Maybe that's not such a big drop, 5% or something. Another data point was interesting. The share of households that use brick and mortar banks is at nearly 82% nationwide. The share of households that only use brick and mortar banks is nearly 10%. So, we have 5,000 banks, I think you said, most recently in the country. They're not going away, but they're under pressure.
Yeah, they're under tremendous pressure. And they're under pressure because of something that the Federal Reserve did and something that they did. In other words, what we're trying to explain about a bank is that a bank is like an oil company. An oil company gets oil from the ground, it puts it to a refinery, and it sells refined products. Banks get money from the Federal Reserve, they put it to work, and they get loans and investments. All right. So the point is, if an oil company doesn't get oil from the ground, it can't sell a lot of refined products. If banks don't increase their capital, they cannot sell a lot of loan products. Now, the banks have got two problems in terms of getting the raw material money that they need. The first problem is they can't afford to pay market rates for deposits, which I just mentioned. In other words, if they got $23 trillion in assets, roughly 19 trillion of those are financial assets, right? And that's how they make their money. They make their money off those financial assets versus the cost of the deposits that they pay to fund those financial assets. If the financial assets are yielding them a below market rate, they can't immediately shift and get rid of $19 trillion worth of assets and flip them into assets which are yielding 5% plus, right? They have to stick with what they're getting on the yield on those assets, which means they cannot pay up for deposits. They cannot pay, 5% for deposits. Just before we started this podcast, I had a 20-minute phone call in which, the person who called me said, how can banks live when Vanguard is now sending out messages to people all over the country saying, we're paying 5.25% for money. Why do you keep your money in the bank? And there's no reason to keep your money in the bank if they're paying 5.25. And the problem that the banks have is they cannot pay 5.25 because they're not they're stuck with $19 trillion worth of assets, which are not yielding above 5.25, which is what they would have to get to pay 5.25 for deposits. So what do the banks have to do? They got to sit there and take it. They got to shrink until interest rates come down, or until, over some 5-10 year period, they're able to adjust the structure of their assets, but they have to shrink. And that's what they're doing. They're not going to compete head to head for money at 5.25% because they can't. And if they can't, people will take their money out. And if the people take their money out, there's going to be a shortage of lending coming from the banking industry. That is going to lead to, at some point, a recession.
Some of what you've been saying, we talk about the banks, we talk about the housing crisis, we talk about, other companies that can operate with these interest rates. And it seems like the solution is lower interest rates. But what we started off with was we need to have interest rates high because of the inflation issue. How do you think this ends? What is your 12, 18-month view of how?
Unfortunately, it is what it was 12 or 18 months ago, and it was wrong 12 or 18 months ago. It is a major recession. In other words, we have a gentleman, Stefan, who works for, ODEON, who has had to back off this position also. But a few months ago, he was arguing strongly, it is impossible to miss a recession. Now, I agree with him. I think it's impossible to miss a recession. I think it's going to be a stiff one. But the point is, it isn't happening. And I'm sick of saying that something's going to happen that doesn't happen. And it isn't happening because you got more jobs, higher wages, higher housing prices, higher stock prices. But I just don't see how it's avoided. I don't see how you avoid it.
Are you young enough to remember the summer of 2008?
Yeah, I think so.
When the Fed went to Jackson Hole and kind of came back patting each other on the back, we solved it. We got Bear Stearns into JP Morgan's hands. What a crisis that was. Thank goodness we're over it. I mean, isn't it always darkest before dawn or just because it hasn't happened yet doesn't mean it's not about to happen, right? Or am I just misremembering history?
I believe we're going to have a recession. I believe it for 18 months. I've been wrong for 18 months, and I'm sick of being wrong. But the point is,
I think you were early. I think you were early the first 6 months, and the last 12 months you're on track, because recessions typically happen anywhere from 18 to 24 months after the yield curve inverts, right. And so that's coming up in this fourth quarter or the first quarter of 2024.
Yeah, no, I mean, I can't change my beliefs which is that we will have a recession. But again, I've said it repeatedly. Can't keep arguing against the market.
Vanguard is offering those blockbuster rates. They're not subject to the same impediments on capital as banks. Did they lose on that, competing with the traditional banks for savings?
They all they have to do is buy treasuries. All I have to do is I'll take your money in, I'll buy treasuries, I get this yield on the treasuries, and I'll give it to you. I'll take a little portion off the top. Money market funds are historically very, very thin margin entities, but the point is they're not under the restraint. They don't own 19 to $20 trillion in financial assets. They don't own that, and they're supposed to keep themselves short. They're not supposed to go out more than 30 days, 90 days at the most in terms of the duration on their portfolios. So they're taking the money in, from the Treasury. The Treasury's paying them this amount of money. They can go into the reverse repo market, and the Federal Reserve will pay them 5.25%. And they just turn around and say, okay, we're getting 5.5%. We'll give you 5.25%. Banks can't do it. Can't do it because they've got 19 to $20 trillion in assets which don't yield 5%.
We could be looking at a government shutdown later in the year over budget wrangling that could be hurtful to the economy. Could that push us further towards that long anticipated recession?
Well, if they're crazy enough to shut down the government, yes, it will be a recession. It'll be worse than that. But again, Nikki Haley, I enjoyed the Republican debate. I thought there were a lot of very intelligent, very appealing people on the stage. I believe that strongly. I do. I thought it was refreshing to hear all these new voices. All right. But Nikki Haley, the ex-governor of South Carolina, said, the Republicans demanded a shutdown or balancing of the budget. And then once that political issue was resolved, they put in earmarks of, I think she said, I forget the number, but I'm going to give you hypothetical numbers, of 5 trillion, and the Democrats put in earmarks of 2 trillion in the new budget bills. So the Republicans, after making this big stink about it, when it came to creating the new budget, they demanded more money in the new budget than the Democrats did. Again, I don't want to get involved in any political stuff, but, I just thought that what she said was, they really don't want to shut down the government. They want to make a political statement about, debt, which I happen to agree with them 100% on. Nobody's going to do anything to shut down the government. Nobody's going to, fail to increase debt as long as the marketplace will accept it.
I disagree. I mean, when you say no one's going to do anything to shut down the government, that almost is overlooking that something has to happen to not shut down the government, because the government's funding runs out, I believe, on September 30th, and that's only 32 days away from today. And they have to pass a budget to continue government spending. Otherwise, everything shuts down. And, the problem, I understand it. And look, I agree with you that when push comes to shove, they find a way to do things. But if nothing happens, the government will shut down. What they have to do, and I believe the Speaker McCarthy won his speakership by promising what they call regular order. And regular order is where you pass budgets by department that go through the committees in a proper order. So the committee passes a budget, then it goes to the floor, and then the floor passes the budget, and then it gets added to a total budget, and then passes the House collectively, then goes to the Senate, and then the president signs it. What we've been doing as a country roughly since, I believe, it started under George W. Bush and continued through Obama and Trump, is we have these crises where they end up just passing giant wholesale budgets at once at the last minute in a fire sale. And the people on the far right that held McCarthy's feet to the fire said, we're not going to do that this time. We're going to get it done through regular order. My understanding is if you start regular order today, the procedural steps that it takes to get through all the committees and get it all through the floor take up too much floor time, given the amount of time between now and September 30th, that McCarthy and a lot of the Democrats in the Senate and Joe Biden are saying we want to pass a continuing resolution which extends last year's budget for a definite period of time, maybe, to mid-November, so that they have time to get all the budgets through the committees into the House floor and whatnot. Far right is saying we won't allow any sort of continuing resolution to get passed, so good luck. And the Democrats are kind of saying to McCarthy, this is your bed, you made it, we're not going to provide votes for your continuing resolution. And so I don't know. I would totally dismiss the idea that the government shuts down, because you do have to actually have positive action from Congress to not have it happen. And, a lot of people are drawing lines in the sand, making it seem like that won't happen. The other thing I would point out in terms of the potential for a recession in the fall is, after almost 4 years of not paying student loans, the government is finally requiring borrowers to start making student loan payments again, beginning October 1st. So September 30th, October 1st, you have two different headwinds that we know are going to hit the economy if Congress doesn't get their act together.
Well, all I can say is if it hits the fan, watch out.
You're predicting it to hit the fan, though.
Because, we can't, the government can't do that to us. They can't shut down government and expect to have an economy function, people who have jobs, anything of that nature.
Stranger things have happened.
Well, I agree. You're definitely correct on that.
Meanwhile, we have to keep our eyes on across the globe. China is weakening. A lot of disturbing noise still coming out of there. They've taken some measures, maybe band-aids, to try to shore up the economy. And in Europe, Germany's economy is shrinking. Headline in the journal, Germany's shrinking economy sparks a struggle for solutions. That's the locomotive of the European Union. Big manufacturing powerhouse, a big capital markets there. If Germany teeters on the brink, that's not good news for Europe. And then we have to deal with China. What does that say about the global economy and where we might be next year as we enter a presidential election?
Well, it says that the global economy is extremely stressed. And it's stressed because Europe can't compete in the open market, Germany being the primary driver of Europe. And that, unfortunately, China misused its, if you will, financial largesse by overinvesting in real estate. The Chinese people can't afford to buy all the real estate that the Chinese government, if you will, subsidized the creation of, so that we've got to shrink. I think that's what it says.
There was an interesting opinion piece by David Wallace Wells in New York Times Magazine over the weekend. He was just saying how quickly China expanded in recent decades. Just phenomenal gangbuster growth between 2008 and 2021, as the globe's per capita GDP grew by 30%. China's grew by a whopping 263%, and China accounted for more than 40% of all global growth during this period. Now it's headed in the other direction. There's implications for markets for the entire globe here.
Yeah, there definitely is. China clearly has got to in fact, China is rethinking its situation. Its Belt and Road Initiative is turning out to be a major problem for it, because the most recent numbers, at least in Foreign Affairs magazine, Francis Fukuyama wrote this thing, said that they have $1 trillion in debt to 100 countries, and the vast majority of those countries can't pay it back. All right, that's one problem. They built these massive cities, which we saw 10, 12 years ago. We saw all of these things coming across the internet showing these cities with no people in them, and that's coming. They have to deal with that. They have not developed a consumer economy. They have been laser focused on technology, industrial production, etc. So they have not developed a consumer economy, and so that's coming to harm them. So they've taken this belligerent approach to large corporations, to outside money, to whether they want Taiwan now or 5 years from now. And so they've done all these things wrong, and they did obviously a huge amount of things right, or they wouldn't have grown the way they did. But they've done all these things wrong, and now they got to deal with it. and in dealing with it, it's going to hurt the global economy.
Part of this story is also the decoupling post-COVID in a lot of ways, and part of it is kind of a collective unitary view that becoming dependent on China is bad for the global world. And so China has a problem where companies, unrelated to China's domestic problems, are motivated to decouple from China at the exact time they're having their own glut of real estate, which is the opposite of America's problem. Their problem is that they have too much real estate, and their second problem is that most of their real estate is owned by their citizens as second and third speculations rather than invested in banks, and so the consumer is distressed because their savings are basically negative value at this point if they're locked into a mortgage on a house that has lost value. And so it's not just their domestic problems that granted are their sole creation, but it's also that companies are decoupling for other outside reasons. And so China is in a world of hurt. I mean, I see these projections where they're like, oh, China will only grow 3% for the next couple of decades. And it's like, well, that seems pretty optimistic when you have a declining population and a declining industrial base and a declining savings base.
I mean, let's hope that things turn around there. I mean, the Chinese, by the way, when we have these conversations, they're just a wonderful, cultured, intelligent people and contributed so much to American society, the ones over here and in their own countries. So, but it's a bizarre and weird time we're in.
Yeah, I think we've reached the maximum potential of debt to bail out the world. And that, is going to put us in a very difficult position because debt got us where we are now, and debt won't be able to take us out of it going forward.
Well, we'll end on that somber note. Maybe we'll open with a positive note next week for episode 85. And until then, take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.